Want to know how depreciation can affect your bottom line as a property investor? Let's crunch some numbers. As a property investor, you can deduct the wear and tear of an investment property against your taxable income. Here's how it works. You buy a brand new apartment for $559,000. You rent it out for $620 per week, earning $32,240 per year. You borrow 80% of the purchase price at 5.5% interest, which costs you $24,596 a year. Other expenses, like rates and management fees, come in at $8,385. Now, let's crunch those numbers. You're getting $32,240 in rent. Subtract the interest, along with your expenses, and you're out of pocket by $741 in the first year. Now, let's factor in depreciation. Depreciation on your property can be claimed as a tax deduction. You just need a company like Washington Brown to work out how much you can claim. Now, back to our calculations. The first year depreciation on this property is $15,000. Add this to your out-of-pocket expenses of $741, and that brings your total tax loss to $15,741. If you're in the 37% tax bracket, that's a tax refund of $5,903. So, you're out of pocket by $741, but you just got a tax refund for $5,903. In other words, your investment property has now paid you $5,162 to own in the first year. And that, my friends, is the power of depreciation. Now, if you like this video, don't forget to subscribe to my Hottest 100 Tax Depreciation Tips on the Washington Brown YouTube channel. Don't forget, results will vary depending upon the age of the property. Now, if you want to work out how much you can claim in depreciation, head over to the Washington Brown website and use our free online tax depreciation calculator.